Hey everyone, it's Mark Ferguson with Invest for More, and welcome to another real estate investing video. Today we're talking about 15 versus 30-year loans. A lot of people are huge proponents of the 15-year loan because it will save you so much money in interest. I am not one of those people. I will give you my perspective on why I think a 30-year loan is the better loan in almost all situations. There might be some situations where 15 years is better, but if you're trying to build wealth, make as much money as you can, the 30-year loan is usually the better option. And yes, you might spend a lot more in interest on that loan, but you're spending it over 30 years. And you need to look at your year by year kind of cash flow, what you're making each year, not at a huge giant figure that bankers and lenders will try and scare you with. And yes, it is the banks, it is lenders who are trying to get you to move into a 15-year loan versus a 30-year loan. And that's gonna be part of this video too. Why would lenders be so adamant about getting people into 15-year loans instead of 30-year loans if it was such an awesome loan for consumers? Wouldn't the banks want to push you into the 30-year loan if that was the worst loan to be in, if that was the loan they made all their money on? It's not the loan they make all their money on. In fact, a lot of local banks that lend their own money won't even offer 30-year fixed-rate loans. Other countries don't even offer 30-year fixed-rate loans. It's kind of the government-backed programs that offer these long-term loans, and then other banks have kind of had to piggyback and do it to compete with those government programs because banks don't want their money locked up for 30 years at an insanely low interest rate that we have right now, 4 or 5%. Rates are so low, and you can lock that in for 30 years. It's such a huge advantage to consumers. Plus, with inflation going up, your payment will literally be lower and lower and lower every year that you have that loan. So a 30-year loan is not the big bad monster that everybody makes it out to be. It can be an incredible tool to build wealth on rental properties, on your own personal house, on commercial properties. I've got all of those. I have 30-year loans on almost all of them. There's one I had to do a 15-year fixed on, but I would have done a 30 if I could. And my payments are lower. I spend much less money on a 30-year loan up until like year 17 or 18. That's when a 15-year loan starts getting cheaper. And I qualify for more properties because my payments are lower. I have more cash flow. I'm making more money now when money is much more valuable than it will be 17 years down the road when inflation kicks in. And really, by the time 30 years is up, money will be worth less than half of what it is worth now. So delaying those payments, that interest, till way in the future is a huge advantage with inflation. Not to mention, most people will never have their loan that long. Most people won't even reach 15 years for a loan. And paying those cheaper, smaller payments is a huge advantage, especially if you're investing that money in something else that makes a much higher return than the 4 or 5% interest that you're paying on the loan. So when you see Quicken advertising, oh, get a 15-year loan, you'll save so much money, they're doing it because it makes them more money. They make money when you refinance, when you get a good loan. So if you switch from a 30 to a 15, they make money. And their money is tied up for a smaller period of time. So if interest rates do go up, they're not locked into those low rates that they can't get out of. So we're going to go over all kinds of things in this video. Numbers on how much a 30-year will cost you versus a 15. Different scenarios on why I think a 30 is almost always better. And lots of other great information. So let's get started right now.
Okay, what we're looking at here is the interest paid in, the principal paid in, and the total amount of money you're paying into a 30-year versus a 15-year loan. So the banks and other people will just talk about the interest. They won't talk about all the other money, and the other money is more important than the interest. That's the point of a loan. The point of a loan is to borrow money so that you can make more money or, do something else with that money instead of pay it all into an investment. So the first column here is a 30-year loan, $200,000 balance at 4% interest. The second column is a 15-year loan, $200,000 balance at 3.5% interest. One big advantage of a 15-year loan is the interest rates are lower. Now, that is something else I want to touch on here. Why would the interest rate be lower on a 15-year loan versus a 30-year loan? If the banks loved 30-year loans and wanted everybody to get 30-year loans, wouldn't they make the interest rate lower on a 30-year loan? That shows right there the banks prefer a shorter term loan. The shorter the loan term, the lower the interest rate is because their money is not locked up. They don't want their money locked up. I do. I want my money, I want to be able to borrow money for as long as I can because the time value of money is so valuable in the future. And I'll show you that here soon too. So I went through certain dates, 3 years from now, 5 years from now, 10 years from now, 15, and then 30 years from now to show how much you're paying into this loan. Here's the payment. It stays the same. One of the fantastic things about fixed rate long-term loans, your payment is the same 30 years from now as it will be now. Now your taxes and insurance might increase, but this is just principal and interest here. This shows you how much principal you're paying versus how much interest you're paying. So in the very beginning, you're paying a lot more interest. However, as time goes on, you pay more and more principal and less interest. Now, it's another huge advantage of low interest rates. If this interest rate was 8 or 9, you pay much more in interest. So low rates are just an incredible advantage for anybody buying a regular house, an investment, whatever it is. And this shows the total interest you're paying in. In 3 years, you would have paid in $24,000. In 5 years, $38,000. 72, 101. The total amount you're paying over 30 years is $143,000. And that's where the banks and advertisers and people trying to market to you will say, you're paying so much interest into this loan, it's a horrible idea, don't do it. I'm going to show you why it's not a horrible idea. And this is the balance here of what your loan is over time. And then this right here is the important number. You should be more concerned with this than you are with this. This is money out of your pocket. So this is how much money you're paying into this loan over time. So after 3 years, you'll pay in $34,000. After 5 years, $57,000, and so on. Now you'll notice after 15 years, you'll pay in $171,000. That's a lot of money, but it's a $200,000 loan over 15 years. The big amount where you really pay in the extra is after the 15 years. And people say, look how much extra money you pay into this property. After the 15-year mark, that shows why 15-year loan is good. However, we're going to look at the 15-year loan numbers. All right, here are your payments. Look at this. $954 payment, $1,429 payment. Even with a lower interest rate, your payment is almost $500 more a month. This is why you pay less interest, because you're paying so much more money into the loan. Now your principal, yes, you're reducing that more. But that's, the point of a loan is to borrow money, not to pay it back, at least in my mind. So interest, you're paying less in interest. That's true. And this shows the total interest you're paying. So you go down through each year. We stopped at 15 years here because the loan is paid off. So you're paying $57,000 in interest versus $143,000 in interest. That's like an $86,000 difference. That's what people advertise. You're paying $86,000 more for a 30-year loan than a 15-year loan. However, look over here. At 15 years, you're paying $257,000 into the loan, where at 30 years, you're paying $171,000 into the loan. I'm going to show you another figure here. You're paying much more money into that 15-year loan to save interest. And so my point is, if you're an investor, if you have anything else you can do with your money that makes you more than 4%, you're better off not paying anything off extra, not getting a 15-year loan, taking this extra money and investing it into something else. And that's what I do. I don't pay anything off early on my cars, on my houses. If I have, I don't have credit card debt, but if I did, I'd pay that off because it's like 18% interest. But the low interest rate loans, I don't pay those off early because I can make 15% on my rental properties. Even if you can make 10% on your rental properties, you're better off not paying off those loans and investing it into more properties instead. So we're going to look at some more things here. Down here, so $5,700 a year paid more with a 15-year loan. Every single year on the same property, you're paying $5,700 more on that 15-year loan. Now, if you have one property, that's a good amount. What if you have 5 properties? So I've got 20 rentals now, a bunch of flips going. You're paying $28,000 more every single year on 5 properties with 15-year loans instead of 30-year loans. That's one rental property a year. You could be buying more And think how much better your portfolio would look with more properties. If you're buying below market value, doing the things I talk about, you have more tax advantages. You're paying down equity on that property as well. You're making a higher return than 4%. At least I sure hope you are. More properties is usually infinitely better than having less paid off properties, in my mind. Now, if you're super safe, extremely conservative, don't want any risk in your life, maybe paid off properties is better, but still, I still think there's risk with having paid off properties too. Now, something else that is super important to look at is inflation. $954, that's the payment up here, so the 30-year loan payment. In 2034, 15 years from now, would be worth about $659 at 2.5% inflation. So I'm looking at historical inflation rates. I'm assuming they might be similar to what they have been in the past, in the future. So your money is worth much less in the future than it is today. Now, if the inflation rate was 3%, your money would be worth even less, $612. If we go out 30 years, your money is worth less than 50% of what it's worth now. So we go back up here, and you see how you're paying all your extra money in at the end of this loan. That is when your money is worth half as much as it is now. So this huge difference here is not nearly as big as it looks because money is not worth as much. You're much better off saving your money and investing it now than paying off much more money now to save money in the future on these minuscule interest rates. Because investing money now will keep growing, will keep compounding. But if you take a bunch of money and just pay off stuff, it's not going to compound. It's actually going to be worth less in the future. I know it's kind of a tricky concept to understand, but your money is worth more now than it is in the future. So if you can save money now and invest it, you're better off than paying off things now and saving interest 30 years into the future. So I'm going to make another little graph here I made to kind of give you a better idea of the difference in what you're paying. 15-year, 30-year difference. After 3 years, you're paying $17,000 more on a 15-year loan. After 5 years, you're paying $28,000, which we already talked about. After 10 years, you're paying $57,000 more. After 15 years, you're paying $85,000, this is money out of your pocket, more for the 15-year loan than you are for the 30-year loan. So instead of looking at interest and how much interest you're supposedly saving, which is all pretty much on paper, none of that money goes into your pocket till you completely pay off the loan, look at how much money you're paying into that loan. If you have one property, after 15 years, you paid $85,000 more. What if you have 10 properties? You just paid $850,000 more into those loans than if you would have had 30-year loans. What could you have done to save or to invest that $850,000, and what would that have gotten you compared to eliminating 10 $954 mortgage payments? Something to think about. That is why I like the 30-year option compared to the 15, because you're paying so much more money into the loan to save that interest. And this one little figure here, the break-even point where you pay the exact same amount into the 15-year loan as a 30-year loan is 22.4 years away. That's when you start paying less on a 15-year loan, is 22.4 years, because you're paying so much more after that 15 years than you are with a 30-year loan. So everyone who's telling you how awesome a 15-year is, how you save so much money, how all this interest is just killing you, it's all smoke and mirrors. Look at what you're paying, not what these fake numbers are. They're not fake, but they're not money in your pocket. It's all paper, basically until 22.4 years away. And how many people are actually owning houses that long, won't refinance, won't sell it, won't do something before that time period? And really you're saving 0.5% of an interest rate, which is not very much. In the grand scheme of things, if you can find good rentals, if you can invest in good properties, you're going to be better off doing a 30-year loan 95% of the time, if you ask me. Now, there's some other things to consider, some other things to look at, and we'll talk about those now.
All right, so there are the numbers that show why a 30-year loan is so much cheaper and costs you so much less money than a 15-year loan, basically until you've had both loans for 22 years. Now, there's other things to consider as well. One of the biggest things to think about is your debt-to-income ratio. So a debt-to-income ratio is basically your monthly expenses. What are your monthly debts, your mortgage, your car payments, credit card payments, compared to what your monthly income is? And this is one of the biggest things banks look at when qualifying for loans, whether it's a personal residence, a rental property. Debt-to-income ratio is extremely important. Now, if you have 15-year loans, as we saw, your payment could be $500 a month higher than a 30-year loan. That destroys your debt-to-income ratio. That makes your debts much higher. And if you have many properties, thousands of dollars a month more in debt that you're responsible for. And the banks look at that, and it makes it much harder to get new loans if you have a bad debt-to-income ratio. Now, if you really, really want to pay off your loans early, you can still get a 30-year loan and pay more off on it every month. That way, if something happens, if you get sick, if something, who knows, you lose your job, you still have the lower payment if you want to go back to it. But if you have extra money, you can pay off the 30-year loan faster. I think that's always a safer route anyway. And yeah, you pay slightly more in interest, but it's really not that much more in the grand scheme of things if you're looking at it at a year-by-year or month-by-month basis. And really, that's what you should be looking at. That's what the banks look at to see how good of a borrower you are, is your month-to-month expenses, debt-to-income ratio, how things are going, not how much interest you save over 30 years. They don't care. That doesn't matter to them in their finances. In fact, your total debt amount, the balance of debt you have, isn't as important to them as your debt-to-income ratio. So you must consider that if you want to buy a lot of properties, if you're looking to buy personal houses, whatever it is, if you want more loans in the future, the 30-year loan is going to be an easier option, a better option than the 15-year loan because the payment is so much higher. Not to mention all the extra money you'll have and you'll save for down payments, for repairs, for things like that as well. So in my mind, the 30-year loan is the better bet. You'll make more money because you're paying less into it. You can buy more rentals, increase those returns. It's safer because the payment's lower. If anything happens to you, you can always go back to paying the lower payment if you really want to pay it off early. And then the time value of money. Money is worth so much less in the future that all that extra interest you're paying is so far down the road that it's not as big a deal as people make it out to be. Not to mention, most people won't even own the properties or have the loans for that long of a period. They'll refinance them or sell them at that point, and it won't make a difference anyway. So for me, I try and get 30-year loans on almost everything I do. Now, there are some limitations you'll run into as an investor. You can do 10 conventional 30-year fixed loans with banks, and at that point, you'll run into some resistance. You might have to go to local banks, what I call portfolio lenders, and a lot of them won't even offer 30-year fixed rate loans because they don't want their money tied up that long. Now, there's some national rental property lenders who do offer 30-year fixed rate loans. You can go to investformore.com/lenders, and I have a list of them. You can always email me, mark@investformore.com as well. Some local banks will do 30-year fixed, but not many. But a lot of them will do 30-year ARMs, where you have a fixed rate for 5 or 7 years. Again, a lot of people get scared about ARMs. No, I don't want an ARM. It's horrible. That's how the housing crisis happened. However, your interest rate is actually lower than a 30-year fixed for the first 5 or 7 years. And you don't actually start paying more until like year 9 or 11, depending on what loan you get, because your interest rate is so much lower in the beginning. So an ARM is not a scary, crazy loan either. Some things to look at. Like I said, I have one 15-year fixed loan because it was a commercial property. It was very low value. It's like $73,000 loan amount. It wasn't a huge deal to me, but I still would have preferred to have the 30-year loan. So there's options out there, things you can do, but if you have the option, go for that 30-year loan if you're really trying to build quickly and build up your empire. All right, thanks for watching. Hope you guys enjoyed the video. If you have comments, leave them below. I try to answer everybody. Give us a thumbs up if you like the content we delivered, if you thought it was valuable. If you have any questions at all, let us know. And, of course, we have many more videos like this if you want to subscribe, and videos of all my flips, rentals. We did 26 flips last year. Try to do more than that, so we have a lot of those videos. All right, thanks for watching.